The live trading price for Applied Digital Corp, ticker APLD, is currently $32.80, reflecting an intraday gain of plus $2.18, which is a plus 7.12% increase as of the latest reading today, October 23, 2025, at 12:56 p.m. Eastern Time. That is a significant surge in a very short window, and it immediately creates a tension between what most people think they know about this stock and the hard, present-day reality of its performance. The common expectation for a company like Applied Digital, a name that, let's be honest, carries some of the lingering baggage from its earlier focus on Bitcoin mining, is volatility and an outsized dependence on crypto cycles. Yet today's move, on top of the already massive year-to-date gain of over 280%, isn't about Bitcoin at all. The real fuel for this stock's relentless climb is a massive multi-billion-dollar pivot that is turning it into a pure-play builder of next-generation AI infrastructure, specifically high-performance computing data centers, or what they and others call AI factories. That's the first insight you need to hold on to. Stop thinking of APLD as a crypto-adjacent stock. You need to start viewing it as a critical hard asset lever to the growth of NVIDIA stock and the hyperscalers who need that high-density computing power. The reality that is exceeding all prior expectations is the almost unbelievable string of massive long-term lease agreements they have locked in recently, which are drastically de-risking the business model and providing a clear, visible path to large-scale, consistent revenue. Just this week, the market reacted strongly to the announcement of a $5 billion AI factory lease with an investment-grade U.S.-based hyperscaler at their new Polaris Forge 2 campus. This deal is staggering, promising an estimated $5 billion in total contracted revenue over a 15-year term. Layer that on top of the already approximately $11 billion in total contracted lease revenue with the fully leased Polaris Forge 1 campus with CoreWeave, an AI hyperscaler. When you put those two together, you're talking about north of $16 billion in potential long-term contracted revenue, a figure that simply dwarfs the company's current market capitalization of just over $9 billion. This is the contrarian take that challenges the typical investor's narrative. The market consensus often sees these smaller infrastructure players as fragile, high-risk, and speculative. The truth is that by securing these enormous multi-decade contracts with credit-worthy large-scale technology firms, Applied Digital is morphing into something that resembles a specialized contracted utility, a business model that is fundamentally more stable and predictable than its volatile stock chart suggests. Looking deeper into the immediate stock movement, the current buying pressure is clearly a reaction to the sheer magnitude and quality of this new $5 billion contract. The intraday volume today, while not yet at the massive levels seen on some of the earlier contract announcement days, is robust, indicating sustained institutional interest. Institutional ownership is already significant, with major players like BlackRock, the Vanguard Group, and even funds holding the stock through various Fidelity ETFs and index funds. The sharp sell-off that occurred earlier in the week, where the stock dropped from above $40 to around $33 following executive share sales, was a classic case of noise obscuring the signal. Traders saw a headline about a CEO selling shares and reacted negatively, fearing a lack of management confidence. Yet the very next news cycle, this $5 billion contract completely overwhelmed that fear, proving that the underlying business momentum is far more powerful than insider trading sentiment. This rapid whiplash is exactly why the average retail investor using platforms like Robinhood stock trading platforms or trying to invest online through a straightforward online investment portal can get shaken out. They focus on the daily drama, not the long-term contracted assets being built in North Dakota. The company's core function is now unequivocally centered on providing high-density, purpose-built data center capacity for the most demanding computing applications, primarily artificial intelligence and high-performance computing. They design, build, and operate these facilities, often securing massive long-term leases before construction is even complete. This pre-contracted model is the genius of their pivot, ensuring a clear return on the massive capital expenditure required for these projects. Their facilities are designed specifically to handle the enormous power and cooling demands of modern GPUs, like those from NVIDIA stock, which is the backbone of the current AI infrastructure build-out. Their earlier business, which included a segment of data center hosting for cryptocurrency mining, is fading in relevance, though it still provides a baseline of recurring revenue. Their fiscal Q1 2026 reports reported earlier this month confirmed this shift, with total revenue up 84% year-over-year, driven significantly by revenue related to tenant fit-out services for their HPC business. This means they are not just renting space, they are actively building out the technical infrastructure for the tenants, deepening the operational ties, and adding an extra layer of non-recurring but high-value service revenue. The profitability metrics are still in the red, a common feature for growth companies focused on heavy capital expenditure and rapid scaling. But the gross profit margin is starting to show the leverage of their model, and the projected annualized net operating income, or NOI run rate, of approximately $500 million once Polaris Forge 1 is fully operational is the number that truly matters to value investors. Management has confidently stated that they are on track for a $1 billion NOI target within the next 5 years, which frames the current $9.2 billion market cap as a bet on a rapid multiple expansion as that NOI visibility becomes a reality. This is an investment that requires patience, similar to long-term holds in Apple stock or a managed portfolio through Schwab Intelligent Portfolios, not daily trading on a mobile app. The capital structure is an important part of the reality check. Building these AI factories is incredibly capital-intensive. This is where their strategic partnerships come into play. They recently executed the first funding milestone in a $5 billion AI infrastructure partnership with Macquarie Asset Management. This arrangement is designed to provide the necessary capital for their large-scale campus projects, significantly reducing the pressure to finance expansion solely through equity, which would dilute existing shareholders. This $5 billion commitment acts as a massive financial runway and a strong vote of confidence from a serious institutional financial player. For those who manage their own capital using an individual brokerage like Interactive Brokers or utilize advisory services from Fidelity Investments, the risk profile here is clearly being managed through strategic financing, even if the absolute debt level has increased. The key is that the debt and capital are being deployed to build contracted assets with long-term revenue visibility, a much better scenario than capital being used for speculative ventures. The future outlook for Applied Digital is a story of capacity and demand. The expectation is simple. AI demand will continue to explode, but the reality is that the physical infrastructure, the power, the cooling, the data center space, is the bottleneck. Applied Digital is one of a handful of companies positioned to be a direct beneficiary of this constraint. Their expansion plans are aggressive, with the new Polaris Forge 2 campus breaking ground and plans to scale capacity far beyond their current contracted megawatts. Possible catalysts for further stock appreciation include the announcement of more anchor tenants for Polaris Forge 2, further expansion in their power allocation that could push their total capacity above 1 gigawatt in the coming years, and critically, the transition of their operational facilities from construction in progress to fully online, which will directly convert contracted revenue into recognized revenue and positive cash flow. The primary risk remains execution. Construction delays, unforeseen operational hurdles, or a major change in the pricing power dynamics with their hyperscale clients. But the quality and duration of their recent contracts suggest a strong pricing position and a mature ability to execute on complex projects. For anyone who has considered using an intelligent portfolio or looked into platforms like SoFi Invest for high-growth tech exposure, this company represents a focused bet on the physical groundwork of the AI boom, offering a different profile than pure software or chip design plays. Let's pause and consider the community's perspective for a moment. Given the massive contracts Applied Digital has signed, $16 billion in potential revenue visibility. Comment below what annual revenue run rate you think APLD will achieve by the end of calendar year 2027. Do you believe the $1 billion NOI target is realistic, or is it too optimistic? Your engagement drives the discussion, just as the interplay between retail activity on Robinhood stock trading platforms and institutional accumulation through large fidelity brokerage accounts drives the daily price action. To summarize the central insight, the market's initial expectation of Applied Digital as a volatile crypto-adjacent infrastructure play has been thoroughly debunked by the reality of its enormous. The live trading price for Applied Digital Corp, ticker APLD, is currently $32.80, reflecting an intraday gain of plus $2.18, which is a plus 7.12% increase as of the latest reading today, October 23, 2025, at 12:15